Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody. Ron LeGrand back with another episode of the Mentor Podcast, designed to help you make more money and keep more of it and retire rich. And speaking of that retiring rich thing, we got a great guest on the line today that's going to help you do that. His name is Nate Hare, and he actually is working at Quest IRA. So our subject today is how to make money and never pay taxes on it. How are you, sir?
I'm doing very good. And remember, it's Quest Trust Company now. We just converted to a trust company.
Oh, we're getting fancy now, huh? Okay,
yeah, but all those words you just said gave me warm and fuzzies. This is right up our alley.
Okay, good. Well, let me start it off by saying that you guys are at all of our quick start schools, and you sign up an awful lot of people into IRAs after we get through browbeating them and making sure they understand why they need them. I don't know how many years that I've been doing that. So we got a very important message today. We got a short time to do it in. So why don't we start off with, why do I need an IRA, and what kind of IRA do I need, Nate?
I think everybody needs an IRA to get Uncle Sam out of their pockets. And that's one of the things that I think a lot of us, especially as investors, we don't get that education. They don't teach it in high school. They don't teach it in college. You really got to seek it out. But these IRAs, or you can call them self-directed IRAs, are a great way to use your knowledge as an investor, but have your investments grow tax-deferred, or even better, tax-free. And we've got several accounts that allow you as an investor to do that. So as soon as you understand how to start making money in real estate and then understand how to minimize or eliminate your taxation, that's where the proof is in the pudding, and that's where magic starts to happen.
All right, well, let's start from scratch. You said self-directed, so let's make sure we understand the difference between Quest and your local bank or brokerage house on that respect.
Yeah, let's define that. So a lot of people hear this term self-directed IRA, and it's important to understand that self-directed is just a marketing term. Self-directed is not a type of IRA. IRAs are the same legally, no matter where you have them. If you have an IRA at Fidelity, that IRA legally is the same IRA you would have at a company like us, Quest Trust Company. The only difference is what the companies do. Your Fidelities and Charles Schwabs of the world, they're in the business to sell investments. They're licensed securities brokers. They sell investments. And when you have an IRA with them, they're only going to allow you to hold in their IRAs what they sell you. It doesn't make them bad guys. Just understand what they're selling you, and that's stocks, bonds, mutual funds, and CDs. Now, an IRA at Quest works differently because we don't have investments to sell. Our account agreement simply states we'll hold anything in your IRA the IRS allows, but you've got to pick the investment. You've got to self-direct it. You tell us what you want in that retirement account. We'll sign off on the documents, and most people don't realize an IRA can hold almost anything. The IRS only tells us we're not allowed to hold life insurance contracts and collectibles in an IRA. Everything else is fair game. So if you want to invest in things like real estate or notes secured by real estate or investments into companies that invest in real estate, there's all sorts of investment options available to us out there. You just have to find a company that's willing to administrate those assets in your IRA.
So to be clear, a company like Fidelity gets a fee every time they put you into some kind of investment. A company like Quest only gets a fee based on your annual amount in your IRA. In fact, why don't we just get your fees out of the way right now? And while you're at it, let's go ahead and tell us what it's going to cost to set up an IRA. And then we're going to get back to why it's so darned important and try to simplify it so people can actually understand. And understand that it has absolutely nothing to do with your contributions. That's not how you're going to get rich in your IRA.
Yeah, I totally agree with you there. Well, with Fidelities and Charles Schwab, you got to realize a lot of the fees that you get charged, you don't even see because how they make money is on commissions on your investments, broker fees, finder fees. I mean, you really got to read through the 100-page prospectus to see all the ways that you're getting charged. And you don't necessarily see it because it's all taken out before you actually get your profit. I think there was a show, I can't remember what it was, but they said about if you have a 401k invested traditionally, you only see about 67% of your actual profit investing into those stocks or mutual funds. So their fees are what we say they're hidden in the back end. Our fees are on the front end because we don't make commissions. We don't sell investments. We don't take any of your profit. All the profit goes back to your IRA. All we do is we're just a fee-based company that charges transaction fees anytime we have to process or purchase an investment. And we have small administration fees for holding those investments in your IRA because you have to have a custodian that holds your IRA assets until you take distributions. So anytime you're going to purchase an investment with your IRA at Quest Trust Company, it's only $125. That's from start to finish. And then maybe just a wire fee of $30. That's not even our charge. That's our bank's charge. So typically, anytime you're going to buy an asset, it's only about $155. And that's actually split amongst the accounts you use. And I'll talk about the accounts here in a second. A lot of our clients use multiple accounts to buy real estate. They don't just use one. And then outside of that, those are just your one-time fees, $155 to purchase an asset. And then your administration fees, which could be quarterly or annually, you can pick, can be anywhere from $99 a year to $295 a year, depending on what you're doing. And the cool thing about our fees is A, they're up front, and B, what I always like to tell people is pay those fees outside of your IRA, meaning don't instruct Quest to take those fees out of your IRA. Pay those personally with a credit card or whatever you got personally, because most likely you can use that as a tax deduction to yourself or put it on your favorite credit card and build points. That's not an option you get with Fidelity when all the fees are taken out before you even see the profit.
So you're telling me then that I can pay the fees charged by the IRA outside of my IRA?
Correct. That's the one fees you can pay is for the administration of the IRA itself.
How about the setup of the IRA?
Setup of the IRA, we typically run specials. Normally, it's $100, per IRA just for the setup, the application costs. But we do like to give specials, especially to your students, Ron, because for us, we only grow when we have educated clients who are good investors. I would rather give credit towards those investors because I know they'll be with me long term and do more investments. So typically we'll allow one of your students to open as many accounts as they want for just one flat $100 application cost.
All right. Well, I got another question for you. Suppose my IRA forms an LLC. Can I pay that state fee to form that out of my pocket, or does my IRA have to pay it?
That's a great question. Anything typically that is investment specific and your IRA is the owner of the investment, the IRA should pay those fees. Okay. So if your IRA is going to invest into an entity, the IRA should pay the fees to set that up.
All right. Well, then let's go ahead and get the ugly side out of the way so we can get back to how to make money with this thing, because there are rules when you have an IRA. So let's just give me the brief summation of what you cannot do or should not do unless you want the IRS gorilla on your back.
Yeah, and nobody wants the IRS on their back. So there are some rules, and these are with all IRAs in general. Even Fidelity has the same rules. You just have to talk about them more when you self-direct your IRA, because you have to be cautious about the people that your IRA are not allowed to invest in, or your IRA cannot benefit certain individuals, and those would be your people restrictions. And those are the most important things to understand, is that you mainly are the main disqualified person to your own IRA. You're the fiduciary of your IRA. You're supposed to help it grow, but your benefit doesn't come until you take distributions at retirement age, preferably. So being the disqualified person to your IRA, that just means you can't self-deal with your IRA. You can't buy your own houses using your IRA. You can't sell your own personal assets to your IRA because you represent both sides, and that's an obvious conflict of interest.
Okay, well, stop. You mean you can't buy the house you live in with your IRA?
You can, yeah. Unfortunately, you cannot buy the house you live in your IRA. It must be investment purposes.
All right. But you most certainly can buy investment properties. We'll get back to that.
And there's plenty of investment properties outside of the ones you might own. There's a lot more out there. The other people that are disqualified to your IRA would also be your spouse and then your lineal ascendants. So lineal ascendants would be parents, grandparents, and lineal descendants, which would be your kids, your grandkids, and their spouses as well, because those are the people that typically, when you die, will inherit the assets. So they look at those people as equal fiduciaries to the account if they're going to be the ones that end up inheriting those assets.
And we can add to that list any entities that you control.
Correct. Any entities that those specific people may own, control, or manage.
So let me sum that up. You cannot be personally compensated in any way from any of the activities of your IRA, and you means all your lineage of descent and any entities you control. Okay, sir, what happens if I get caught self-dealing like that?
If you get caught self-dealing with it, consider your IRA bye-bye. The IRS does not like when people break these rules because the IRAs that they give us have very, very good tax benefits for us. There's an ability to grow true tax-free wealth with things in these accounts, and they're not nice when you try to skirt the rules. So it's not like messing around and playing in the gray area on your taxes. You might just get slapped on the wrist and get a little penalty. When you dance in the gray with the IRA rules and the IRS doesn't like it, they basically just say, here's your entire IRA back, pay us all the taxes and penalties on it, and they start charging you penalties from the day you did whatever was prohibited. So it just doesn't make sense to mess around with these rules. And the one thing that I always tell people is if you're looking at your IRA as a way to benefit yourself before taking distributions, you're looking at IRAs the wrong way anyways. Your IRA should be set up for the future, for your retirement. If you want to make money today, use other people's IRAs to do that, not your own.
Yeah. How many times do you think I get that question?
All the time. We get it all the time too.
All right. But, let's don't mislead our folks because they can take money out of their IRA anytime they want. So let's talk about the proper way to do that.
So, and I'm assuming you're talking about distributions?
Yeah.
Okay. So there's always you can always take distributions. And obviously most of the IRAs are set up to where the distributions aren't completely tax-free or penalty-free until you're after 59 and a half. I know Ron likes to talk about this, and so do we, but we love the Roth IRA here at Quest Trust Company because if you can utilize a Roth IRA to hold your real estate assets or whatever investment you choose, by the time you hit 59 and a half and you've had a Roth IRA open for 5 years, well, then that's the beauty part. All your distributions from that point on are tax-free and penalty-free for the rest of your life and the life of your heirs. So that's really how to get off the grid and get Uncle Sam completely out of your pocket.
So let's clarify, tax-free, not tax-deferred like a traditional IRA.
Right. Tax-deferred just means you're going to pay taxes on the entire bucket. So if you're a guy or gal that can take a small amount of money and make it larger, the Roth IRA is the way to go and have those distributions tax-free and penalty-free.
So what if I have a traditional now? How do I get a Roth? Can I transfer it? And what's the price?
You can. Nowadays, anybody, regardless of your income, can pay taxes on what they have in their traditional IRAs and convert those to Roths. You don't have to do all of it. We have a lot of clients that will chip away at their traditional IRAs and pay a little bit of tax each time to convert it. But basically, you're just taking it from a pre-tax account to an after-tax account. And all that means is you just got to pay the taxes in the year in which you did the conversion. So if you're doing the conversion today, you pay the taxes next April. So
for the sake of our high income people listening, there's an income limit by which you cannot open a Roth IRA. And what is that now, Nate? $180,000, something like that?
Yeah, if you're a single filer, it's about $127,000, I think is what it is now. And if you're married filing jointly, it's around $190,000. And that just prevents you from making a direct contribution to a Roth. Nowadays, since they took the income limit off conversions, anybody can get money in a Roth. You just might have to put it in the traditional first.
All right, let's go back here. All right, guys, listen up. If you're in a high income, that does not mean you cannot have a Roth. Do not listen to people who tell you can't have a Roth. What Nate just told you is you have to start with a traditional and then transfer it to a Roth. Upside is you got a Roth that you can operate out of the rest of your life. Downside is you can't contribute to it as long as you're in that high income tax bracket. And frankly, who cares? Because contributions is not what this is all about. By the way, I can open a Roth at any age, unlike a traditional, where I have to start taking it out at 70 and a half, correct?
Correct. You can't make contributions to a traditional after 70 and a half.
So in Ron's opinion, I can't imagine why anybody would want anything except a Roth unless they're doing a traditional in order to get to a Roth. So really what you're telling me is I can open a Roth, put $1,000 in it, and then transfer that to, a traditional, put $1,000 in it, transfer that to a Roth, pay the taxes on that $1,000, and then I can have a Roth the rest of my life. Is that what you're saying?
Yep. But I will say this for the listeners: don't take for granted that rule will be around forever. That rule just appeared in 2010, where they took that income limit off. Mm-hmm. They only did that because we were coming out of a recession and they needed to generate tax dollars. Now that we're far away from the recession, they might put that income limit back on. So if you're a six-figure income earner, take advantage now while it's here today. You don't know if it's going to be here tomorrow.
For that matter, they might change any and all of these rules. So I always tell everybody, you better get yourself a Roth and buy like a bat out of hell.
I tell them the same thing too. People always try to ask about these doomsday scenarios about what if. There's no what if. It's here today. Take advantage of it today before it changes.
All right. Well, let's talk about how because this is the part people do not understand. All they can think about is their contributions. So let me handle this. I'm in the business of teaching people how to buy and sell real estate without using their money or credit, both inside and outside the IRA. And your IRA has no credit, nor can it guarantee debt, but it most certainly can borrow money as long as it's non-recourse, such as investors borrow from private lenders to buy and rehab junkers. So the goal here is, I hope you get this, and if you didn't, play it back again. It's not about your contributions. It's about learning how to buy real estate without using your money or credit, and then simply using your Roth as the vehicle to do that with instead of you. If your Roth puts up $100 option deposit or $100 earnest money deposit to tie up a property, and then you go flip that property, for example, let's say you're wholesaling a house, and then you make $20,000, that $20,000 has to go in your Roth, tax-free forever. And I will tell you, your CPA nor your attorney completely understands this. They understand Roths can buy real estate. They just don't know how to do it without using your money. So when you marry these two, you got a gold mine. You can grow this thing so fast and make your head spin. In fact, this is what most of your investors do. They either buy notes or they buy houses, right?
They do. Most of our assets are real estate based in some way. And truthfully, most of our clients actually own notes secured by real estate or investments into private entities. And those entities usually end up buying real estate. I have a lot of clients that will invest in an LLC. The LLC owns an apartment building. So sometimes if you group other people's IRAs together, you don't need a large IRA to do that. You just need a little bit of a network.
Yeah. And your IRAs are the prime source of private money across the country as well, because they can lend investors money at, 7, 8, 9% interest, well secured by a property at a low loan-to-value ratio. And what a great use of the IRA. In fact, I've personally made a couple of thousand loans for other people out of their IRAs when I was a mortgage broker way back. And today it's just as valid and useful as it was then. So you just mentioned something about an entity. I'm not going to get off onto that, but I teach people to form their own LLC and then do business out of that when they're buying the properties, so they don't have to go back and forth with Quest so much. But let's don't get into that today. One thing I definitely want to cover, and that is a CESA for those who have kids or grandkids under the age of 18. Would you explain that, please? CESA. What does that stand for?
Yeah. So one of the other 7 accounts that we have is a CESA, which stands for Coverdell Education Savings Account. Now, the wonderful thing about this Coverdell Education Savings Account is you can invest, make contributions and invest it and self-direct it just like you can other accounts. However, the benefit is the profit that goes back to the Coverdell can be distributed at any time to pay for your children's qualified education expenses. And this is not just for college expenses. This is expenses from kindergarten all the way through college. So those would be expenses like tuition if they're going to private school, uniforms, even if they're not going to private school, tutoring, books, computers, all the things that parents have to pay for anyways to get their children through school. And most parents are paying it with the money in their savings account or checking account, which is their most expensive bucket of money because that's all your after-tax money. Well, as soon as you can switch your mindset as an investor and understand how you can utilize this Coverdell to hold and profit from some of these investments, well, now you get to consume more education expenses with the same amount of money because you get Uncle Sam out of your pocket. You basically can pay for all your children's education expenses with tax-free dollars instead of trying to work so hard and paying it with your dollars, which are taxable.
So basically, what you just said was open each of your children a CISA, and they got to have it before they're 18, or it's too late. And then I don't know, put $1,000 in it because the child doesn't have to even have earned income. But then the cool part is you take that CISA and you do a deal with it, just like you would your own Roth, and take that same $100 and make that same $20,000 in your CISA, and there sits the money to pay for your kids' education and beyond. Of course, if they're going to send them to Harvard, they're probably going to need a few deals, but it's still better than writing a check and saving. I don't know how many people in this country scrimp and save to put their kids through college when really all they got to do is go do one deal in the CISA.
Well,
by the way,
we have a Ron LeGrand student basically paid for an entire year of college in one deal. It took him 8 weeks, $100 wholesale deal in his son's Coverdell education account, and he flipped the contract and made $40,000 in 8 weeks.
No kidding.
That's how you do it right there.
You mean some of my people actually listen to me?
Some of the people actually listen, yeah.
Okay. So anyway, let's say I got 4 kids, I got 4 CISAs, I can still do one deal and put all 4 kids in the same CISA and split it up as long as my distributions, or actually my profit, is equal to the kids' investments, is what I'm trying to say. Not sure I phrased that right. Yeah.
Yeah, well, and you can partner the CISAs with your own Roths and your other accounts too. So that's really where you can combine all the tax-free benefit by using multiple accounts on the same investment.
Yeah, and the kid don't even have to be yours as long as a parent or guardian a guardian signs for them as well. Because I know I got a couple of students that I've met that actually are doing this for kids in orphanages.
Oh, that's
pretty
awesome.
Cool.
That is awesome.
Okay. Well, listen, we got to tell everybody what UBIT means, and that's on you.
Okay. Well, unrelated.
UBIT.
Okay. Well, unrelated business income tax. It's probably a longer conversation, but there are some investments within the IRA world that can trigger a tax to the IRA. Now, this is not the taxes you're normally talking about, where you might pay taxes on a distribution or something like that. This is actually a tax that will kick in depending on the investment you have in your IRA. There's 3 circumstances. If your IRA owns a business, an operating business, typically if it's in competition with other businesses, your IRA isn't allowed to keep all the profit on that business completely tax-free. That would be an unfair business advantage. So in that circumstance, you just have to realize that you have to split a little bit of your profit with Uncle Sam. It doesn't make the investment bad. We always say UBIT is not something to be scared of, just be aware of it. If your IRA owns a business, it may have to pay taxes, and the tax is called unrelated business income tax. The other circumstance is if your IRA owns personal property. Most people don't invest in personal property unless you're buying mobile homes that aren't attached to the land. That mobile home could be considered personal property. That UBIT tax may kick in. And then another one, which is the more common one, I think, is if your IRA owns debt leveraged property, meaning there's debt on the property, your IRA doesn't own 100% of it, you are subject to UBIT to the extent that you're debt leveraged. So if you buy a property subject to, and there's 70% debt on that property, 70% of your profit could be subject to tax. Now, we teach a class on this that there's a lot of offsetting factors you can use. Once your IRA is paying tax, you can start using depreciation and expenses to offset that tax. So a really good CPA will actually kind of show you that UBIT tax is very, very small, a lot smaller than people would think. It's just scary when they hear tax. But again, it doesn't make the investment bad. I've seen people actually use debt to their advantage. If they've got a $100,000 IRA, what's better, buy one house for $100,000 or buy 3 houses with $30,000 down? You might do better with the 3 houses, and even if you have to pay a little bit of tax on the debt, you're still winding up ahead.
Well, on the other hand, let me forget all these things. As of 2010, there's a new rule that if the debt's paid off for at least a year after you sell it, there is no UBIT.
Well, that's on the capital gains. Mm-hmm.
Okay, so let me be clear here. You said if I'm 70% leveraged, I'm only paying taxes on the 30% that I would gain, which would be normal, I guess. But then what kind of a tax rate are we talking about on the gain?
So if your IRA owns the property and the IRA is the taxpayer, there's actually a trust bracket. There's trust rates. Now, the difficult part about trust rates is they're very onerous. They steepen out very quickly. It's like a marginal tax bracket. However, you're at the very top tax rate, which is 37.5%, at $12,500. So it steepens out very, very fast. There's ways to avoid that and minimize that. I don't really have time to go over that today, but what you were talking about, Ron, you still got to factor in the rental income. If they're holding it for a rental, that has to be factored in on a yearly basis. But you're right on the capital gains. If you pay the note off and you have no debt for another 12 months after that, you won't have to pay any UBIT on the capital gains part.
Mm-hmm. And there is one other way to fix this. And that is if I know I'm going to buy a property that is leveraged. In other words, that would be owner financing or taking over the debt subject to, or if I buy it and then put a private loan on it, then that's all going to trigger UBIT. But of course, if I'm taking over debt or I'm buying subject to, I could always lease option it instead of actually taking title to it. And there would be no UBIT because there's no debt. Would that be correct?
Yeah, there's several ways. Another way would be you could wrap the note. Wrap notes actually don't trigger UBIT. Or if you're self-employed, wrap notes.
What did you just say?
Wrap notes don't trigger UBIT. There's one opinion.
You're telling me if I buy a house on a wraparound mortgage, it doesn't trigger UBIT?
It does not trigger UBIT. That's one of the interesting ones. You would think it would, but there's an opinion letter from the IRS, several years back that said that they don't view wrap notes as debt leverage property.
I need a copy of that, sir. I did not know that.
Yeah, well, I'll send you a copy of it.
Well, I learned something today.
Oh, there you go. And the other thing, Ron, too, is for anybody out there who is self-employed, if you're going to buy debt leverage property and you have a solo 401k, one cool thing about a solo 401k is there is a built-in exemption to UBIT on debt leverage property. So you don't even have to pay it. You don't even have to worry about it if you're buying it within a 401k.
Oh, no kidding. I did not know that either.
Well, you learn.
Of course, that's another whole conversation.
That's a whole other conversation.
Yeah, but well, golly, I'm glad we had this talk today. All right, so tell me, how do I get a hold of you, and how do I get in on this special deal where I can buy as many IRAs as I want for only $100?
Yeah, well, this is just for you, your students, Ron. So if anybody wants to take advantage of that, I would just email our special email address that goes to our IRA specialist. The email address is iraspecialists@questtrust.com, or you can just go to our website, questtrust.com, take a look at some of our education there and contact us directly through there. And one of our certified IRA specialists will help walk you through the process of getting set up, getting some money moved over, and getting you ready to invest.
Mm-hmm. Or you can get to one of my quick start schools and they'll be there live signing you up and teaching you more on this stuff as well. All right. And by the way, if you want to get some free stuff from me, I mean, you can go a lot of places. If you want my book, in fact, it's on audio now on how to be a quick turn real estate entrepreneur. You can get that at ronsfreebook.com. And if you like my wholesaling course, which is a great thing to do with your IRA, you can get that for free. Well, you can get it for $1 at ronsdollardeal.com. And you can download that whole $600 course there. And of course, ronlegrand.com's got pretty much everything on it. So go take a look and see how so many people are making so much money. And if I keep pounding them, we'll make as much of it as possible tax free. By the way, my IRA is with Quest, and I found them a whole lot easier to deal with than I did my previous IRA company. So, all right, any last brilliant statements or words you want to impart onto our listeners today, Mr. Nate? I
would just say, just take action. Right now we're in that time of year where people are making contributions for last year, for 2018. So if you haven't made contributions for a Roth or a CISA, do it for last year before you hit that tax filing deadline. And if you need more money in there, make a 2019 contribution too, and actually start putting this stuff in play because it works. It's no mystery. But if you take Ron's education and you apply it with our education, he gives you like the cake, and we give you the icing on the cake to show you how to do it all tax free. But you got to take action.
Now that's pretty cool. You thought of that all by yourself, huh?
Oh, yeah.
All right. Okay. All right. Well, I appreciate you taking the time to share with our listeners today, and I appreciate all you listeners tuning in, and we'll see you on the next Mentor podcast. And you go sign up for it so you can get alerted every time we play it. We play it every Wednesday as of this recording, and it's the Mentor podcast. Not hard to find. Google it or Google me. You'll find it pretty quick. So thank you, and thank you, Nate, and I'll see you soon next event.
Thank you, Ron. Thanks, everyone, for listening. Have a good one.
Okay, bye.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.